provide a little bit value for the people and really understand what the multifamily deals can offer for them. Maybe we can talk about both, active investing, passive investing, because obviously, as we kind of prior discussed before I started recording interview, deal a lot, with people, building relationships and showing them how they can be part of the deals that you and your team has, and invest in those deals passively and take advantage of portfolio diversification. Maybe they're moving from stocks or something like that, and taking advantage of tax advantages that multifamily has to offer. So, but maybe starting with the active side as well, because one of the pieces that you mentioned you want to talk about is underwriting, right? And especially in the current environment, which is very interesting to look at right now. And maybe we can talk about where do you think the economy is going to go as well in the next 6 to 12 months. So specifically talking underwriting, would you like to talk about underwriting in terms of deal or underwriting in terms of a loan? Because obviously you specialize in both.
Yeah, I can definitely cover both. Maybe where we can start is talk about some of the trends that I'm observing today and that are giving me a little bit of a concern, or at least that will also give people insight into my decision making, my criteria, how I make decisions, and they can tailor according to theirs, and we can start there. But the one thing I love about underwriting actually is that it's a lot of people think of it as this heavy mathematics, and yes, that is the quant part is a big part of it, but it's also very dynamic, ever changing and ever evolving. You're not just plugging in numbers in a spreadsheet, but it's I would categorize it as an intellectual exercise of understanding the risk, understanding the markets, sub-markets, macroeconomic factors, microeconomic factors. And so 3 trends that I'm observing lately in deals that are coming across my desk that are giving me either a reason to pause or not move forward, and in many cases a reason of concern, is number 1 is observing compression in cap rates in the pro forma exit assumptions. And why that is relevant for the audience members who may not be as familiar with that concept is because the cap rate effectively has a multiplier effect on the valuation of the property. If you're into the more traditional space, maybe think of it as the inverse of the EBITDA multiple, how you evaluate companies.
Yep.
And so when projecting a lower cap rate, effectively you as an operator are making the assumption your market will be stronger by the time I exit the deal, so my valuation will be exponentially higher. And where I have concerns with that is the reality is, at least I speak for myself, but I believe for many people, I don't know where the market will be 3, 5, 7 years from now. There could be another major economic event. And so when you're uncertain, in my humble view, it's best to project that the market at best will remain the same if you're in a strong market like an LA or New York, but in most cases, perhaps project that it will get worse. And if it doesn't get worse, meaning if cap rates don't compress, then you've already built in quite a bit of buffer, and it can overperform relative to what you're projecting. But what I see in a lot of deals today is a projection of cap rate compression, and that likely has to do with people's outlooks, right? If they firmly believe rates will go back to near zero levels or very low levels, then I suppose it's okay to make that assumption. But here in the US, and you see that where we're at today is actually pretty close to that long-term historical average. It's very difficult to get through that assumption in particular. Number 2 is the reserves, and that's a huge factor. The reality is you cannot project anything and everything, and that will go wrong with the property, or surprises that may come along the way. And the reality is it's not a question of if, but when. Surprises always happen. So it's important to have that, what I call rainy day fund or working capital reserve bucket, CapEx overage.
Which has to be raised additionally for while you raising for investment. Yeah.
And I'm so glad you said that, because a lot of people also don't do that. They're thinking, well, if the deal cash flows, I'm gonna carve out a portion of that cash flow to build my reserves. But what if that cash flow doesn't come? Or an environment that we're going through today, insurance, right? In a lot of markets, California, Florida, Texas, coastal areas, it has grown exponentially, and in some cases three times. Like, nobody could have projected that, nobody. But that's where that's a situation where you would lean in and dip into your reserves to cover some of those unexpected surprises. So what I see, unfortunately, in a lot of deals is either no reserves, just like you stated, so they're not even raising the capital for that upfront, or very low reserves, 1, 2, maybe 3 months. And from my experience as a lender and investor, that's just not enough.
Yeah.
And number 3 is the assumption that the property will go from 0 to hero within the first year. And I'm not saying that's impossible. Everything's possible in life, right? But my experience has shown that it always takes time to transition the property, transition the books and records, implement new policies and procedures where tenants start paying on time, and if not, you're taking timely action to address the issue. In most cases, especially in value add deals where you typically go in and improve the interior of the units or the exterior, but especially if interior work is involved, there will be some downtime for you to perform the work and then lease up the unit. So to assume that there will be 0 transition period, in my humble view, is very optimistic and unrealistic. Of course, if you make any of these assumptions or a combination thereof, that exponentially inflates returns. So what's presented to you as a, say, 17% IRR deal, in reality is probably a 7% IRR deal. And so those are probably 3 areas within the underwriting that I've noticed over the past few months that I thought I would share.
Yeah. So so from the passive investor side. So again, when they're looking at the PPM or having a conversation with an investor, is the IRR becomes the most important metric that they should pay attention when it comes to possibly investing in a deal? Is it cash and cash? Is it just general cash flow? What type of number a passive investor should be looking for?
And I'll say the answer is it depends. So, and I'll give you an example. So if you're looking at, say, a typical, what I call medium-term flip, which is what syndications are, right? You flip every 3 to 5, maybe 7 years, something that's relatively medium-term. I would say IRR, because what you have to factor in is the time value of money. Of course, when it comes to returns, the one caveat I'll always make is look under the hood. Peel the onion to its core, because the assumptions you put in dictate the output or the projected returns of the model. So IRR is important, but just as important is to understand what goes into it. Now, if you are investing in a forever buy and hold deal, and there are those out there, then IRR becomes less relevant because it factors in that time value of money, which is bringing forever to the present, which is not as relevant. So in those cases, I would focus more on the cash on cash return, and that to me would be more relevant. So that becomes particularly relevant in, say, smaller deals, JVs that tend to be forever buy and hold. So then you're basically focusing on how much am I getting for my money back. But personally, what I like to look at is a combination of the two, the cash on cash, the IRR, the equity multiple, which in a simple way provides you with a picture of what's my overall return on investment. If I put 100K today, how much do I get back over that projected 3, 5, 7 year hold period? So I definitely look at that. And the cash flow, I'm a cash flow investor, so that's particularly important to me. But if you're someone who maybe is not as concerned, right, about cash flow, then the cash on cash perhaps is less relevant.
Okay, thank you, Vessi, for that. With today's terms, again, if we're looking from the active side, from your perspective and from your team's perspective, what is a good deal for you today?
Very
underwriting.
Yeah, very well risk mitigated deal. And so what do I mean by that? I'm looking for a number of cushions or a number of levers, one of which comes through cash flow. I would like to see a deal that cash flows on day one. In other words, if I adjust
by cash flow.
cash flow, exactly. If I adjust all the expenses for the changes that I know will happen post acquisition, such as taxes, insurance, potentially labor, payroll, and if I don't do anything to rents because of whatever macroeconomic factors, am I still cash flow positive? And after I pay my debt, because you have to honor the lender, right? That's our biggest partner. So after I do all of that, am I cash flow positive? And if the answer is yes, that's a positive sign for me. Number two is I look at positive leverage, and usually that's an indicator of cash flow. And what I mean by that is I would like my entry cap rate or my purchase price cap rate to exceed my cost of debt. And so that's something that I look at. I specifically actually pay attention to the yield on cost, and I like the yield on cost a little better than just looking at cap rate, because it captures all of my expenses associated with purchasing the property. So the yield on cost would capture the purchase price, the capex, and any other transactional expenses related to the purchase, whereas the cap rate solely captures the purchase price. So I would like that to exceed the cost of debt. And then adequate reserves, because especially in I would say in any market, but especially in today's market, you need to have that rainy day fund. So that's with respect to the financials. With respect to the market, I would like to see a market with strong fundamentals, with growing population, job diversity, high or decent median household income. By high or decent, I mean, for me, that number is 50,000 or more. And ideally a market that has strong supply and demand dynamics. In other words, I don't like to see oversupply in the market. So that's extremely important for me. And if I don't see those factors, then that naturally impacts the underwrite. So that may change some of the assessment of my assessment of the deal.
So, Vessi, if you don't mind, just stopping you for a second here, because for the audience, just to understand and obviously clarify if I'm wrong here as well, that, you know, when it comes to permits and starts, right, when the new properties are starting to being built, with specifically multifamily properties, right, probably until it accounts and we start seeing these units in economy, especially when we're talking under or oversupply, it's going to be until the finish the finish date of the project, which it could be 2-3 years from now. And obviously, I was looking at the statistics. There's an incredible amount of construction started at the Q1, Q2 at 2022, which is obviously now at the end of 24, 25. You know, an economy expecting 1 million additional units, right? So how do you account that, you know, the starts and finishes of the newly developed projects?
So I look at the market data, and typically there are a number of ways you can find out. The most popular report out there is CoStar. So there's a report called CoStar Underwriting Report. So almost every syndicator looks at it. If it's not CoStar, then there is Yardi. I think RealPage has the equivalent of that, and they will give you the underlying data to show how many units are under construction, how many units are about to be completed, how many were just completed. So you get a good sense of the pipeline over the next 1, 2, and 3 years. And if you're doing a typical 5-year hold, then that's a moment to pause and think, well, I thought I may be getting 10% rent growth to catch up with market, but if all this supply comes on board, there may be some pressures. There likely will be some pressures on rent. So I should reconsider, right, my assumptions, and then see if the deal still makes sense in that scenario where perhaps you assume 0 rent growth, or maybe in some cases rent decline, depending on how severe the supply situation is. So it really boils down to looking at the data, and that's hyper local. So, you know, say the market in Savannah, Georgia is different than the market in Statesboro, which is different than the market in Atlanta, which is different than the market in Augusta, Georgia. And so, so it's important to get the data. And for primary markets, even a lot of the brokerage houses would publish that openly. They have quarterly market reports that they release. So even if you don't have access to CoStar, Yardi, and RealPage, which are all paid subscriptions, you can still get some of that data. it becomes more challenging for the secondary and tertiary markets, especially for tertiary. So that's where you really need to dig into additional reports, like talking to your lender or a mortgage broker contact. Perhaps they can pull some appraisals, recent appraisals, to see what the data is. Looking at the local chamber of commerce, county, you have to do a little bit more digging, right? Because the data would not be as readily available, and probably fewer comps in some of those smaller markets.
So again, and you very well explained, the reasons how the due diligence process should work before you think, on investing in those properties. What else would you say? Why do so many, and obviously we talked about, operational, funds feeding that when it comes to a raise, and obviously, securing your loan, and, depending on type of loan that you have, if it's institutional, a bridge loan. But what other issues do you see? Why is it the case that we see so many syndicators are having issues right now?
For me, it boils down to three simple reasons that I've observed over the past couple of years. One is aggressive underwriting. Two is lack of focus on operations. And three is misalignment between the business plan and the debt structure. And I can go into a little bit more detail in all of those, but having observed what I have and relaying it to my own experience as an investor and a lender, it boils down to these three.
And again, the middle one, which is the kind of the first ones, the first and a third one is obviously more obvious. The middle piece, which I don't know, through these interviews, maybe it's the questions that I ask, maybe it's that. But I believe that I was asking questions, to certain people about management, and I see certain people on social media as they, where they have maybe 3-4 billion, assets under management. They emphasize that very highly, when it comes to property management, because a lot of maybe investors, they get, cocky sometimes, especially when it comes to tenants. Maybe they don't do enough credit checks. And you get a tenant that is going to severely damage your income, plus damage the property, which will means turnover, a property that you have to spend money on, plus again damage the reputation for other residents, right? So can we talk about management, because there's so much to take away there. I mean, how much of a importance the management is when you acquire the deal?
Oh, it's probably one of the most important things, and it's the most difficult job, the most thankless job, the least glorified job, but the most important job, because it's operations. Really boils down to, are you able to execute on the business plan, and are you able to pivot, and how are you pivoting when challenges arise? And for better or worse, we were in an up market for a very long time, pretty much. I guess in the multifamily space, what bottom was 2010, maybe 2011. So that's roughly 14 years of upside. Well, I guess till 22. So 11 to 12 years of upside, which is a pretty long expansion period. So nobody really got tested to see how they'll perform in a downside, and especially over the between the period past COVID, so around 2020, 2022, right? Things were going up right before the Fed started increasing rates. So rents were going exponentially, and every property manager out there looked like a hero, because there wasn't there was a ton of demand, not enough supply. Personally, what I like to see is, when I select operators, is vertically integrated ones, mostly because that allows them to be one step closer to operations versus going through a third-party property manager. Now, I'm not opposed at all to working with property managers, and in some markets that may make a better sense. But what I like to see when I vet operators is that they've worked with that particular PM over a number of assets, over a number of years, to a point where one could even argue they're quasi a member of their immediate team. So I like to see that, and and it's challenging, right? Because oftentimes when you interview a property manager, I would say make sure you talk to the actual person who managed the property or the decision maker, because oftentimes you talk to their business development person, and that's someone, they'll tell you everything you want to hear, but not what you need to hear. So it's important to decipher through that as well, to ensure that how they operate aligns with how you want to run the business, ensure that their track record is within an asset class that you are looking to buy and manage, right? A Class A property manager is not going to be the same as a Class C property manager, for example. So there are a ton of questions and conversations that take place, but unfortunately you find out only after you hire how that experience is working out, which is why it's important to have if you're outsourcing that function, right? If you're not internally managing, it's especially important to have a very strong asset management function within the team to ensure that you have you're monitoring the performance. You're not waiting a month. You need to be talking.
It should be often on a weekly basis, right? At least.
At least I would say at least weekly basis you should be meeting, and if the PM is declining to do that, then right from the start that's probably not going to be a good fit. So so yeah, I mean, it's constant monitoring, watching, because you have to be proactive, so you have enough time to address the issues or catch them before they become issues. Because once they become issues, then obviously the challenges to deal with them are larger, at least when it comes to day-to-day operations.
Oh yeah, Vessi. So I think that's where the issue is hidden, right? So because the deals are available, obviously, maybe as back in the past when we were talking about 14 years going through the upside and going through the good times, maybe it took 50, 100 deals to find 1 or 2 deals. Maybe it takes now 200 to really just go through and find a good deal. But look, the money is still available, deals are still available. But exactly what I'm hearing, what you're describing, is that a lot of these properties now are going back to the banks, going back to the lenders, going back to the market, and obviously, unfortunately, some of those syndicators are going, for foreclosure just because the management, they either pick the wrong management or, something is wrong with the operations. And I hear that quite a lot right now.
Yeah. It's that, and I'll add one more point: lack of focus. So it's imperative that, especially if you decide to be on the operations side, it's imperative, in my view, to be focused on the market, because that's how you become an expert on that market. That's how you build, who's who in the local market. You build those relationships. So come in handy. What I see very often is in some syndication shows, they jump. One deal is in Arkansas, one deal is in Ohio, one deal is in Georgia. So it's very difficult to manage when you're hopping from market to market without really having good understanding of the underlying fundamentals. So that also impacts your ability to focus and then ability to asset manage the manager.
Yeah. Oh, so true. So true. Exactly. So another good takeaway. So, and especially, with the property management, just picking the property manager, and I think that's where the focus really doesn't go for it. And I've been watching a tremendous amount of videos when it comes to just property management and basically how you should be vetting a property manager, because the property manager is almost the, it's almost the key piece in terms of just business operations, because we're talking about a simple thing, market rents, right? And again, if we would talk about those weekly meetings, right, you want to make sure that your property is in that range of a market rents and the competitors, whatever they're doing. You don't want to be behind. You don't want to losing that opportunity. But also when it comes to just looking at the paperwork, because you might be overcharged on many different things when it comes to property management, right? So really going through the documentation and make sure that you really understand it. Same as insurance. You want to make sure that you go through that and you understand that your property is going to be fully covered, right? So it's very, very important. So I think maybe the lack of attention towards that, because as far as a few people that are heard that, have a few $1 billion under management, they've been talking about that a lot of syndicators are in trouble because they're not doing that. Because obviously a lot of people that we see right now doing syndications, they're just people just like you and me, right? They're not born into the business. They transition into the business, and obviously for them, as maybe they're go to a mastermind, listen to the podcast just like this. Okay, deal flow and raising capital, right? So kind of the missing the middle piece, which is again management.
Yes. And then unfortunately, there's also the third group, right? They did everything right. They improved the NOI, they executed on the business plan, but now they're getting caught up in the market factors, right? So if you bought a deal at a 5% cap rate and now it's trading at 6.5%, right? Even if you did everything right, it's very difficult to battle against that multiplier effect that
that's why you shouldn't buy it, on cap rate only. You should buy cash flow only, right? So
cash flow and so it's very difficult, right? So for some of those operators, right, they did everything right in terms of operation, everything. The underwrite, they probably projected at least some expansion, but they couldn't have predicted expansion from 5 to 6.5, right, in 3 or 4 years. So so those are some situations where, but if they've done everything right, there's probably some equity built up, so those would be probably better positioned for maybe cash in refi or perhaps have other options working with the lender so they can, if they can, wait out.
Because if we're talking about institutional, like if we're talking about Freddie Mac, like, or just a bank, like bank really doesn't want to take the property back, because that's going to be, a point off from them, right? So they actually going to start. So the more, in trouble you are, probably the more inclined they're going to be to work with you and try to resolve the issue.
Well, yeah, it depends actually. I would say it depends because I'm a former lender, right? So a lot of it boils down to a number of reasons. So if you're dealing with people who are good operators, strong character, you understand that. Just the example I was giving, they got caught into bad timing, right? Because nobody could have predicted how high rates would go and for how long they'll stay there, thereby impacting cap rate.
It increased like 11 times at least, right?
Yeah, at least 12 times in like 18 months or something like that, and it has settled since. So as a lender, you have incentive to work with those borrowers. But if you're dealing in a situation where maybe they don't have enough liquidity, right? So that it's important that the GPs can step in and bring enough liquidity to the deal, or maybe bad character, or they were doing things that they were not supposed to be doing. And you get to a point where you see, okay, the deal is basically unsalvageable. So I may, if you're prudently lending, right, even if prices fell from the peak, right, 20%, but if you lend at a 75 LTV as a lender, you're covered. So you may just say, okay, I'm gonna move on if you're not looking to continue that particular borrowing relationship. But in some cases, you may just say, okay, this is unsalvageable. There's no point in waiting. The guys are illiquid. They haven't operated the property. They've run it to the ground, right? Holding this on my books isn't, and that's not gonna fly with the auditors either, right? When they go audit their credit portfolio, at some point that's gonna be flagged as well. So in some cases, those tough decisions will be made. But what I observe in the market today is a lot of, I heard someone mention the term extend and pretend. So they're doing a lot of extensions and modifications. A lot of the maturities from 23 were pushed into this year. I suspect some of those will be pushed into next year, but I think those will happen for the good operators who have some liquidity to step in, because it's a two-sided street. It's not just going to be the lender restructuring. There's the operator, borrower, they'll have to give in something as well.
Yeah, makes sense. Regarding somebody who's looking to get started, and obviously we have an audience here for that, right? A few things that also we wanted to discuss. Again, W-2. So again, for people, it's having a job, right? At least that's what it's called in US. I don't know for whatever reason, right? So, but how does somebody who is, because all these things that you're describing, it might be just flying over the head for a lot of people, so how does somebody who's looking to go into real estate, and maybe we can talk about, because again, as mentioned, you're involved in both single family, multifamily. So with the current market terms that the market dictates, regardless of the state that they're in, what would you say, like, what's a good start where people can start? And is the single family would be a way, or if they have that bug, they really want to transition on multifamily, should they pursue that? And is syndication a good deal, or maybe a 4-plex or a 16 unit could be a good start?
So it depends. And why do I say that? Because I would say that probably the first step every investor should take is decide, how do I want to be engaged? Do I want to be engaged actively, where I'm doing a lot of the heavy lifting? Because even single family homes, oftentimes people describe them as passive income, and it's passive for tax purposes, but it's truly not passive. It will be putting
$350 a month. I mean, is it worth it? Maybe.
Exactly. So do you want to be involved actively or passively? And then once you make that decision, is what's important to you? Is it cash flow? Is it appreciation? Are you looking to mitigate a tax problem, right? Because that will then drive what type of business model, what types of deals am I looking at? If you going to decide, or even asset class, that would be another factor. So let's just say, for example, you select, I like the residential space. Let's just say you like multifamily. Well, if cash flow is not important to you, if you're looking to build equity, and if you're willing to take more risk, maybe you go into new construction deals, right? But if cash flow is more important to you, then you are probably looking at more stabilized deal or stable value add types of deals. And then once you make that determination to figure out, how do I want to play, active or passive, what asset class, and what are my investment criteria of the four that I mentioned, cash flow, appreciation, tax, and then capital preservation, is get educated. Go all in, because at the end of the day, what I like to say is that you have fiduciary responsibility towards yourself, towards your loved ones, to make an informed investment decision. Information and opportunities will be presented to you, but at the end of the day, you need to be able to look under the hood and peel the onion to ensure that the information is well vetted. And find operators, syndicators, if you decide to do this passively. If you're doing this actively, getting into the right networks, again, getting educated. And last but not least is taking action, because you could be talking to people all the time, studying, but nothing will happen if you're just sitting behind the screen, right? And not taking any action. So those are the steps I would recommend people take, or at least those are the steps I took when I started my own investment journey that were helpful and instrumental in moving me forward. And one more thing I would add is, in my case, my journey was very incremental. That's what worked for me. Now, that is not to say you couldn't start with a 100-unit apartment building, maybe invest first passively in it before you manage it actively. But I took a very gradual approach. I started with a single family home. Once I understood that, I moved to a duplex. Once I did a duplex, I did an 11-unit. Once I did an 11-unit, I did 150 units. So I didn't go from 0 to 150, but that's what worked for me.
Yeah. And I see that happening, in some of the operators, that they sometimes start just like you did. So it could be a single family property, maybe a 4-plex, 16 units, maybe 50 units. And obviously at some point you're just going to cap out, and you will understand, okay, I need equity. I need somebody else's. I need to go and raise, to buy bigger deals.
Yes.
The only one way is up, is more, right? If you continue to
go. Yes. Yeah. Especially if you decide scaling up, you have to be comfortable working with others, teaming up with others, whether it's for skills, workflow management, or capital. You will need people to scale. That's for sure. So teamwork, working with people, becomes incredibly important.
Oh yeah. So, but becoming a team member yourself, or for example, if somebody's starting by themselves, all those different pieces. So again, if we talked about underwriting, networking with people, that's a big piece. Maybe not a lot of people are comfortable within that. There's a lot of, introverted type of people that are really comfortable, maybe, there's some internal conversations have to be made, and some books have to be read in terms of maybe limitations that we have, and who am I to talk with these people, and whatever that could be. Plus, again, sales experience, marketing experience, asset management, property management, like all those other pieces that's needed to acquire and manage a deal. So what would you say for a new beginner investor, like where should they focus on? Is it deal flow, which means underwriting, or where's the good start for them?
I would say actually figure out what your strength is and what you're passionate about. And that's the activity I would recommend you focus on. And then
Okay, so
find
website development, is that a good
Oh,
start?
okay.
Develop
Website
that?
development. So if you're in website development, they're probably good into technology, maybe marketing.
Yeah.
So and
Find
then
off
from
market deals or something, right? Get creative.
yeah, get creative or and website development, to me, that's very technical. So I would make an assumption that okay, you may probably gravitate towards the number. So yeah, finding deals, underwriting deals, that may be an area you focus on.
Yeah.
And then partner up with people who bring other skill sets. So if asset management, capital raising is not your area of strengths, find good partners through networking, joining masterminds. There are a ton of investor forums. Have
Yeah.
multiple conversations to figure out who brings not only the skill set gap, because that's important, but who aligns with my values. Actually, I would start there first, because it's very easy to get into partnerships, very difficult to get out of it if you make a bad decision. So so align there first, but you don't have to do it all. You don't have to know it all. Otherwise, if you are, then you're capped, right? In terms of time or money, or at some point skills, right? So it's important to figure out what are my gaps, and then start working towards filling these gaps by finding people with complementary skills.
Oh, for sure. This is not a business to be in if you're a solopreneur or trying to be a solopreneur. This is a teamwork. This is a team project. It might be a big project. I mean, if it's 100 units, look, you're gonna take down that by yourself. First of all, again, you might have no experience, no net worth, so you're gonna be needing both. You're gonna be needing cash equity. So and relationships, which again, you want to bring on board probably members that have relationships with brokers, have an existing network of people that probably would like to invest. And, but again, you mentioned there is masterminds, there's lots of events happening right now, virtual, in person, and obviously we're organizing an event in October 26th, 27th, a 2-day Saturday, Sunday event where people from different parts of the world, a lot of people from Europe as well, we're going to be talking about everything from finding a deal on market, off market, then financing, finding partners, selling, exit strategies, underwriting, whatever it could be, a wide array of spectrum ideas, because information is information. And then Bigger Pockets is another great platform. I'm a member there as well, and I see lots of people networking. If you post something in a forum, people will come back with you like that, and be like, hey, let's chat, let's have a conversation. So it is possible to find those people if you're in the United States, grabbing a lunch, picking a brain, as they said, But another things that you wanted to talk about, obviously, being also from outside but working inside of the States, how does someone can invest being out of state?
Yes, so it's actually taking the teamwork concept that we just talked about becomes imperative, right? Because then you really depend on your core team, which is your property manager, mortgage broker, or lender, the boots on the ground. I will always recommend have at least one boots on the ground contact if you're not able to travel there frequently, and then potentially contractor as well. And so it starts with understanding the market, understanding the sub-market, and then building your team. And that takes time, and it's definitely uncomfortable, right? Because you cannot drive there within 30 minutes to an hour. So you really need to get comfortable with that. In my case, what I did, I actually flew there for the first time to meet the local property management team. I had studied the neighborhood online, and nowadays there are a ton of resources that give you, I would say, pretty good research actually on the neighborhood and submarket. But nothing replaces you kicking the tires, as we like to say here, is driving around the neighborhood, walking around, just to get a sense of, for me at least, the question was, is this a place where I would live in, right? Because if you pass that test, then the decision becomes very clear, and still being engaged. So in my case, in the single family portfolio, was building that team and then monitoring, reading the monthly financials. In the multifamily space, I align myself with operators who are based in those markets. So then I have a peace of mind. Okay, I don't have to be there every week or once a month, because they're there. They're within an hour or two at most from the properties and can go visit them if for whatever reason there are issues. So I would say boots on the ground, building your team, and then again being very diligent in monitoring the investment or asset managing effectively.
Yeah, that's a great advice. Again, the biggest portion as far as I see, you know, and it is definitely a recurring theme of the podcast, you know, and we speak a lot about that. And obviously, as Vessi mentioned before, which if we rewind that, if you guys rewind that, Vessi was talking about, oh, this is not a numbers game. It's fine, you're fine. And then we started talking about these numbers. So it is intense. It is intense. Again, for you, maybe, you know, it's coming from your background, being involved in numbers for a long time. It seems like, oh, okay, and it feels like you're like underwriting deals, right? So that's your thing. So, but for a lot of people, it could cause some headaches. But it's part of the journey. Again, as a mentor, incremental growth, right? So, and we talk about mindset a lot because obviously we're not born into this, as I mentioned before. You know, it's a process for us to make that transition, and it's sometimes uncomfortable, you know, transition. But if we have a goal to becoming, you know, an investor and doing that successfully, you know, we need to really take charge of our destiny by means, okay, I need books, you know, we talked about seminars, events, whatever that is. How does your routine look like back in the past? And how does it look right now in terms of just, you know, the kind of the expanding mind and reaching for the next goal?
Yeah, so that's something you're constantly working on, that, right? That mindset work never changes. And for me, there are three factors that have been really helpful. And actually, that's the reason why I named my company as such, which is Dream, Believe, Achieve. And one is having the clarity of the goal and why you want it. And that's extremely important because you need to know where you're headed, right? And we talked about, for example, as an investor, defining your criteria, defining your risk appetite. That really shapes which lane are you going to drive in or which lane are you going to stay in. But your why is what will propel you further during good times and pull you up during bad times or challenging moments, which inevitably arise. Real estate is not an easy business. I mean, nothing is easy in life, right? Everything has challenges. So I cringe sometimes when I see people talking about investors sitting on a beach with their pina coladas. It's like, this is too far from reality. There's a lot of work required, but it's
investor, maybe that's the case, but even that probably gonna have a few sleepless nights.
Even then you still have to do some work, at least on the front end, right, when vetting the investment. And so having your goals clear and then your why. Then number two is surrounding yourself with positive, like-minded individuals, which will help reinforce that belief in yourself. Having role models. I like to look up to successful people because when I see them succeed, even though they're maybe 10, 20, 30 steps ahead of me, all I need to know is that it's possible. And that motivates me to move forward and keep going. And then achieve, right, is the taking action, because you could be daydreaming, right, every day, but you have to take that action. So while you're working a full-time corporate job, for me, a lot of that work was happening outside of hours or during lunch breaks, weekends. Basically, anytime I wasn't in the office doing my corporate job, I would be studying, reading, meeting with people, and then eventually I started taking action. So in the beginning, it feels intense, but again, going back to what is your why? Why are you doing this? And that will really push you on the days where you're working, 18-hour days or 12-hour days, whatever it may be. But you need to have a really strong reason on why you're doing that.
And what is your reason?
Positive impact and significance, having the freedom of time, the flexibility to be with people in my life that matter to me, and to put the skills and talents unique skills and talents that God gave me to good use and positive impact. And my job definitely allowed me to do that. So it's not like I didn't like my job, but now as an entrepreneur, of course, the challenges are different, but I love the flexibility of the time. So it's a different, just a different, different situation. Or I guess someone told me, pick your heart, right? It's not, neither one is easy. There are always challenges, but it's what's the one and the setup that works best for you.
Exactly. That's indeed. So, and I think, people, as I also made the mistake, in the past, sometimes you look at people and you mentioned for inspiration, people that they're doing, better than you, right? And probably you already have to be doing something or at least gain some momentum to really appreciate that and take that internally as inspiration. Because I think, for most of the people, that becomes as almost like discouragement. It's like, oh my God, who am
Oh,
I? They're
yes.
doing, it's such a big
Yes.
gap sometimes for
Yes.
people that it is like, it discourages people from doing anything
Yes.
because they're too
Yes.
smart. They have too many, connections, capital, they might born into this and maybe they say a few sentences or a few words. Oh, I finished Harvard. Oh
Yeah.
my God, I don't have that. Right.
No, it's and that's why it's important. I keep mentioning look under the hood too, right? Because for the longest time, I'll tell you, I was wondering, what am I doing wrong? Because back in 2021, right, a lot of people were doing deals and I just couldn't get deals to pencil. And there was a point where I even started questioning myself. Now I have a lot of my answers, right? Now I know how deals are getting done and why they were getting done, and people were just being overly aggressive, right? Or doing things they shouldn't have been. So I would say don't always take it at face value, right? And there's a lot of things that happen on social media that create a certain image, but the reality is different, right? So take the time and again, know what your values are, know what your criteria and standards are, and especially in periods of turbulence like the one we're going through today, it's hard, but stick to your criteria and know that in the end you will prevail, because not always the things are the way they appear that they are. So that's also important to keep in mind.
Oh, of course, of course. And we have a lot of Gen Z people listening as well. Again, and I almost missed the mark. I'm born in 1989. But the one thing that's lacking maybe with the Gen Z is patience, right? And that's the thing that is required to succeed in anything, right? To have that incremental growth and change, but doesn't happen overnight, right? Unless you're
Oh,
born into
yes.
it, which not many people can say that. So it's really going to be uncomfortable sometimes, but again, as I said, if you find a strong why, and you have to have those drivers constantly reminding you why you're going to be doing that. Because, this sounds like, I'm pretty sure it already discouraged some people when you said, I worked a full-time job and after work and during the weekend, I did this. And people are like, oh my God, I'm already tired from work and now I have to do this. Well, yeah, because that's what it
Yes.
takes, because that's what it takes. You have to do
Yes.
that. So, and you need to find strong reasons,
Right.
why you're going to be doing this, even if you're tired, even if you don't feel like it, it's raining, you want to go
Yes.
on holidays. Look, you
Yes.
want to live the life or whatever the reasons are. You want to get a car, house, take care of
Right.
your family, spend the time with the people that you really like.
Right.
You'll have to work, but either you're going to work on your
Yeah.
job or you're going to work on yourself, because those two
Right.
things are going to pay different dividends. So
Yeah, no, there's no free lunch. You've got to you have to put in the work. And you asked about my wine. What you just mentioned brought in one more reason, and that's a big one for me as well, as the fear of regret. I don't want to
Oh
look
my
back 20 years from now and think, oh, I should have at least tried it, right? At least tried it. So that got me started, and
I just got the goosebumps. I don't know if you can see this, but this is
yeah.
I think this is the worst, because some people that heard, for example, Ed Milet, right, and Les Brown, and maybe a million of other people talked about this, that the worst thing that you can experience is lay on a deathbed and being surrounded by potential you. There's a you as an investor, you as this great father or mother, you as this person that has millions of people as friends, whatever that is, and they're looking at you with the eyes, and it's like, look, this could be you, but you missed all of that, and that's the time you cannot get back. That's it. I mean, that's the end of the journey. Depending on a religion that you believe in. But it's a tough spot to be in. It's a tough spot.
Absolutely. So yeah, put in the work so you don't have any regrets, but you have to put in the work. Nothing, there's no free lunch. Yes.
Exactly. So if that's the only one takeaway that you guys and girls can take away from this interview, I think it was well worth watching or listening. Because just a reminder of that, because sometimes, you know, these days common sense isn't common, and sometimes we just have to get reminded, even though we might know it. I remind myself on certain things to continue to move further, grow more, do more. And life is about that, right? Those constant reminders. Why are you doing this? Why you want to do this? And I think, you know, what you mentioned, that really is focusing on your growth, getting focused on the thing that you're good at, right? Really immersing yourself and going through those, you know, pain thresholds. That's where we can make things happen. And obviously, for more information, again, if you look into because the success really lies into proximity as well as getting close to the people that are great, right? So DBA Capital Group, if you want to reach out to Vessi, you're going to find obviously that included in the show notes, together with her LinkedIn, if she doesn't mind, you know, people reaching out and talking with you.
Please do. I love talking to fellow investors.
Here you go. So reach out to her on LinkedIn and obviously start that conversation, and, you know, ask her questions about her investments. Before we started recording, you mentioned that you have deals right now at the moment, and obviously I'm sure you have many others, and there are the great deals coming on the pipeline. So reach out to her and have a chat about that, either active or passive investing. I'm sure you can have a great conversation. Vessi, I really appreciate you for coming on the show. Look, I got some reminders here myself, so I really thank you for that.
Absolutely. I really enjoyed our conversation, and thanks for having me.
Thank you.